Hello, everyone, and welcome. I'm Miss Elena. I'm a corporate executive, and today I want to share one of the first important financial decisions I ever made after graduating from college. Before I managed large projects and corporate budgets, I was just a nervous new graduate with my first real job offer in Houston, Texas. I remember feeling excited. I finally had a salary. I finally had a career. I finally felt like I was entering the real world. Then reality arrived very quickly. I needed a place to live. And suddenly, everyone had advice. People told me renting is throwing money away. Others told me buy a house immediately. Some people said buying builds wealth. Others warned me not to lock myself into something too soon. I became overwhelmed. Then I realized something important. I was not simply choosing between an apartment and a house. I was making a financial management decision involving risk, costs, and my future. And honestly, I had no idea what the right answer was. A few days later, I started seriously looking at apartments around Houston. At first, renting looked incredibly attractive. Everything felt simple. I could choose a place, sign a lease, pay a security deposit, move in, and start my new life. No huge upfront payment, no mortgage paperwork, no long-term commitment. And honestly, flexibility sounded very valuable to me. I had just graduated. I was starting my first corporate job. I had no idea where my career would take me. What if I received a promotion in another city? What if I changed companies? What if I discovered I hated my commute? Renting seemed to give me freedom. I also noticed something else. If something broke, I would not be the one paying for it. If the air conditioner stopped working during a Houston summer, I could call the landlord. If plumbing problems appeared, I could call the landlord. If maintenance was needed, I could call the landlord. That sounded wonderful to me. But then I started thinking more carefully. Every monthly rent payment was buying me a place to live, but it was not creating ownership. It was not building equity. I remember thinking, if I pay rent for years, where does all that money actually go? And that question stayed in my mind. That question pushed me to start looking at houses. And I have to admit something. The idea of buying a home felt exciting. I remember scrolling through home listings and imagining my future. I started thinking, this could actually be mine. Not an apartment I temporarily lived in. Not a place owned by someone else. Mine. I pictured decorating the rooms exactly how I wanted. I imagined inviting friends over. I imagined building a life there. Then I started reading more about homeownership. I learned that homeowners gradually build equity. That means as mortgage payments reduce the loan balance, ownership in the property increases over time. I liked that idea immediately, because instead of simply paying for a place to stay, I would slowly own more and more of an asset. And I also learned something else. Homes can sometimes increase in value over time. So I started becoming very optimistic. I remember thinking, wait a minute. Maybe buying is automatically better. But then I opened a mortgage calculator, and suddenly my excitement became a little more complicated. I remember sitting in my apartment one evening with a mortgage calculator open on my laptop. I found a home I liked and started entering numbers: home price, down payment, interest rate, loan term. Then I started learning how mortgages actually work. I realized a mortgage is not simply borrowing money to buy a house. The house itself becomes collateral for the loan. I also learned some important terms. Principal is the amount borrowed. Interest is the cost of borrowing that money. The term is the length of the loan, often 15 or 30 years. And the down payment is the amount paid up front. At first, the monthly payment looked manageable. I thought, maybe I can actually do this. Then I looked at the total amount paid over the life of the mortgage. I stared at the screen for a few seconds. Then I checked the numbers again. I thought I had made a mistake. I suddenly realized that over many years, interest can add an enormous amount to the total cost. That was the moment I learned an important lesson. Never focus only on the monthly payment. Always understand the total financial cost. Just when I thought I was finally understanding mortgages, another decision appeared: fixed rate mortgage or adjustable rate mortgage. I remember thinking, wait, now I have to choose between different kinds of mortgages too? So I started reading and asking questions. A fixed-rate mortgage seemed straightforward. The interest rate stays the same throughout the loan. That meant predictable monthly payments. And I liked predictable. Predictability feels comfortable when you're young and just starting your career. Then I looked at adjustable-rate mortgages, often called ARMs. The initial interest rates sometimes looked lower, and at first, that looked attractive. Lower payments sounded great, but then I learned something important. After an initial period, the interest rate could change, and if rates increased, my payments could increase too. Suddenly, I started thinking about risk. Could I comfortably handle higher payments in the future? Could I predict where interest rates would go? The answer was simple. I could not. And I remember thinking something that I still tell people today. Sometimes the cheapest option today does not always mean the safest option tomorrow. At that point, I was becoming very confident. I thought, okay, I understand mortgages now. I can probably buy a house. Then reality interrupted me again. I suddenly realized something important. Wanting a mortgage and qualifying for a mortgage are not the same thing. Lenders were not simply going to hand me hundreds of thousands of dollars because I had a new job. They wanted numbers. They wanted information. They wanted evidence that I could repay the loan. I learned that lenders usually examine things like credit score, income, and debt-to-income ratio. The debt-to-income ratio compares your monthly debt payments to your monthly income. The lower the ratio, the better. I started looking at my own financial situation. I had student loans, I had some expenses, and I had only recently started earning a full-time salary. For the first time, I started seeing my finances through the eyes of a lender. And I remember thinking, wow, they are evaluating me almost like companies evaluate investment projects. Suddenly, finance no longer felt like something happening in a classroom. It felt very personal. At that point, I thought I had almost finished my decision. I knew the mortgage payment. I understood interest rates. I understood qualification requirements. Then I discovered something else. The mortgage payment was not the entire cost of owning a home. Not even close. I started reading about property taxes, then homeowner's insurance, then maintenance costs, then possible repairs. And I remember thinking, wait, I have to pay for all of this too? If an appliance breaks, I pay. If the roof needs repairs, I pay. If something unexpected happens, I pay. I realized homeowners need to prepare for expenses that renters may never even think about. Suddenly, the monthly mortgage payments stopped looking like the entire picture. I learned an important lesson that I still remember today. When making financial decisions, hidden costs matter. Sometimes the costs you don't initially see become the costs that surprise you later. After weeks of thinking, calculating, and changing my mind repeatedly, I finally decided to compare everything side by side. I wrote down the monthly rent. Then I wrote down the estimated mortgage payment. Then property taxes, insurance, maintenance costs, down payment requirements, everything. Then I asked myself some questions. How long was I planning to stay in Houston? Did I have enough savings? Was I financially ready? Was I buying because it made financial sense, or because people kept telling me that buying a house automatically meant success? That question really stayed with me, because I realized something important. Buying a home is not always the correct answer. Renting is not always the wrong answer. The best financial decision depends on the situation, the numbers, and the person making the decision. For the first time, I stopped asking which option is better, and I started asking which option is better for me. So, after all the calculations, all the research, and all the stress, I finally made my decision. I decided to rent. And honestly, some people were surprised. A few people told me I was making a mistake. Others said I should start building equity immediately. But I looked at my own situation carefully. I had just started my career. I was still learning about my job. I was still building savings. And I still didn't know whether Houston would be my long-term home. For me, flexibility had value. Lower upfront costs had value. Less financial pressure had value. I realized something important. Good financial decisions are not about copying what everyone else does. Good financial decisions happen when your choice matches your own goals, finances, and circumstances. Years later, I eventually bought a home, but I bought it when I felt financially and personally ready. And for me, that timing made all the difference. Before we finish today, I want to leave you with a few important lessons from my experience. Renting provides flexibility and often requires lower upfront costs. Buying can help build equity and potentially create long-term wealth. Mortgages involve more than monthly payments. You must understand principal, interest, loan terms, qualification requirements, and additional ownership costs. And most importantly, financial decisions should never be made simply because other people tell you what to do. The right decision depends on your goals, your finances, your timeline, and your personal situation. I hope my story helped you understand not only the concepts, but also how these ideas appear in real life. Thank you for spending this time with me. I'm Ms. Elena, and I look forward to seeing you in our next video.